Bond yields are a crucial economic barometer because they provide valuable insights into various aspects of the economy, including expectations for future growth, inflation, and investor sentiment. Here we will discuss why bond yields are considered a key economic indicator. But first, if you're new here, then do subscribe to us before starting. Bonds are a type of loan that are given by an investor to a borrower for a predetermined amount of time in exchange for interest payments on a regular basis. The term to maturity refers to the period of time that elapses between the time that the bond is issued and the time that the borrower has pledged to repay the debt. There are two types of bonds: government bonds, in which the government itself is the borrower, and corporate bonds, in which a corporation or a financial institution is the borrower. In contrast to a conventional loan, a bond can be traded with other investors on a financial market after it has been issued. This is the primary distinction between the two types of investment. This is the reason why a bond has a price on the market. Acquiring knowledge of bond yields. To begin, let's take a look at bonds. Bonds are financial instruments that deliver one or more predetermined payments at predetermined intervals. In the process of selling a bond, the buyer can either lend money to the seller or the seller can borrow money from the buyer of the bond. Because of this, it is essential for the investors to take into consideration the quantity of recompense that they would receive in regard to their investment. One method for doing so is to keep an eye on the yield of a bond. Bond yield can be calculated in a number of different ways, including current yield and yield to maturity, which are both examples of different definitions. Bond yields are a crucial economic barometer because they provide valuable insights into various aspects of the economy, including expectations for future growth, inflation, and investor sentiment. Here's why bond yields are considered a key economic indicator. Interest rates and monetary policy. Bond yields are closely tied to interest rates set by central banks. Central banks adjust interest rates to achieve their monetary policy objectives, such as controlling inflation, stimulating economic growth, or stabilizing financial markets. Changes in bond yields reflect market expectations regarding future interest rate movements. For instance, rising bond yields may indicate expectations of tighter monetary policy to combat inflation, while falling yields may signal expectations of looser monetary policy to stimulate economic activity. Inflation expectations. Bond yields incorporate investors' expectations for future inflation. Inflation erodes the purchasing power of fixed income investments like bonds. Therefore, investors demand higher yields on bonds to compensate for expected inflation. When bond yields rise faster than inflation expectations, it suggests concerns about rising inflationary pressures. Conversely, when bond yields fall below inflation expectations, it may signal expectations of subdued inflation or deflationary pressures. Economic growth outlook. Bond yields also reflect market expectations for future economic growth. Higher bond yields may indicate optimism about economic prospects as investors demand higher returns on their investments in anticipation of stronger economic activity. Conversely, declining bond yields may signal concerns about economic growth prospects, prompting investors to seek the safety of bonds despite lower yields. Risk appetite and investor sentiment. Bond yields are influenced by investor sentiment and risk appetite. In times of market uncertainty or heightened risk aversion, investors may flock to safe haven assets like government bonds, driving down yields. Conversely, during periods of optimism and confidence, investors may shift towards riskier assets, leading to higher bond yields as compensation for taking on additional risk. Global economic conditions. Bond yields can also reflect global economic conditions and market dynamics. Investors often compare bond yields across different countries to assess relative attractiveness. Changes in bond yields in major economies can influence capital flows and exchange rates, impacting domestic financial conditions and economic outlook. Financial market stability. Bond yields play a role in assessing financial market stability. Rapid and significant movements in bond yields can signal underlying vulnerabilities or disruptions in financial markets. Central banks and policymakers closely monitor bond markets to gauge financial market conditions and take appropriate measures to maintain stability. Right now's yield. The current yield of a bond is the predicted yearly return of the bond, which is calculated by taking the bond's current price and the annual interest payment. When compared to another type of yield known as coupon yield, current yield is distinguished from the latter because the former takes into account the current market value of the bond, whereas the latter takes into consideration the bond's initial face value. In light of the fact that the market price of a bond can be different from its par or face value, this distinction is exceptionally significant. Annual interest payment divided by the current market value makes up the current yield. There is a clear indication that the present yield is subject to change in accordance with the market price of the bond. The coupon yield will be equal to 4% or 4% if the face value of the bond is $100 and it pays an annual coupon payment of $4. On the other hand, if an investor purchases the bond at a premium, that is, if they buy it at the current market price of $105, the current yield will be 4/105ths, which is around 3.8%. This yield is somewhat lower than the coupon yield. In the case of U.S. Treasuries, which are government debt issued by the United States Department of the Treasury, the relationship between bond prices and yields is inversely proportional. This means that the higher the price, the lower the yield, and vice versa. The yields on Treasury securities are a measure of the confidence of investors. Now that we have a better understanding of what bond yields are, we can begin to investigate the reasons why investors, including those who do not invest in bonds themselves, consider them to be an essential predictor of the country's economic prospects. Investors frequently take Treasury yields into consideration. As a result of the fact that the United States government guarantees the security of Treasuries, they are considered to be among the most secure investments and serve as a benchmark for a variety of computations. Chris Neely, an economist who works as a vice president in the research division of the St. Louis Federal Reserve, mentions that during boom times, two things take place. The difference between the yields of risky bonds and Treasuries narrows as a result of the fact that investors demand less of an incentive, additional projected return, to retain risky assets. When there is a greater demand for borrowing money for investment and consumption, yields on riskless bonds have a tendency to increase. On the other hand, when investors' confidence is low, there will be a boost in demand for Treasuries, which will result in an increase in the prices of Treasuries and a decrease in their yields. It is for this reason that falling Treasury rates are frequently interpreted as a possible indication of a slowdown in economic activity. The daily market yield on the United States 10-year Treasury is displayed in the graph that can be found above. There is a clear indication that the yield experienced a considerable decline during the COVID-19 induced recession, which occurred while investor confidence was low. There is a signal sent by the Treasury yield curve to the economy. The yields on Treasury securities that have different maturities are variable. A yield curve is a graph that depicts the yields on debt instruments with comparable levels of risk, such as Treasuries, throughout a range of maturities. The yield curve that is drawn for Treasury securities is one of the most common yield curves that is drawn in the United States. One of the most common yield curves depicts yields increasing with maturity. The yield curve that is most commonly seen is the one that exhibits a growing yield with increasing maturity, as seen in the image above. Shorter-term interest rates have a tendency to move in tandem with the Federal Reserve's policy rate, often known as the federal funds rate. Bonds that have a longer maturity term typically offer higher yields because investors who tie up their money for longer periods of time tend to anticipate a greater payout since they are concerned about suffering significant capital losses on long-term debt. When investors lose faith in the economy, however, it is not unusual for the yield curve to invert. This phenomenon is observed rather frequently. In the event that long-term investors anticipate a decrease in short-term interest rates in the future, they may attempt to lock in the current returns, which might result in an inverted yield curve. This occurs when the yields on short-term investments are higher than the yields on long-term investments. Overall, bond yields serve as a valuable barometer of economic and financial market conditions, providing insights into interest rate expectations, inflation outlook, economic growth prospects, investor sentiment, and financial market stability. Policymakers, investors, and analysts carefully analyze bond yields to make informed decisions and assess the overall health of the economy. Tell about your opinions on this in the comments section below. Do hit that like button and subscribe before leaving.